I'm going to kick it off right away, and I'm going to be talking about silver and why I think we're still in the very early stages of a secular silver bull market, and that it's really just getting started. I'm going to start off on a lighter note, talking about global debt. We are someone got that joke. That's good. You know, if you look at the U.S., which is, of course, the world's biggest financial market, it's certainly not encouraging. This chart shows interest costs on the national debt in the U.S. And, of course, in that circle that I have over there, that's the 2020 to 2025 or till today range. And you can see how it's spiked up. Of course, massive quantitative easing, not just in the U.S., but globally. And the section after that dotted line, that vertical dotted line, is actually the projections by the Congressional Budget Office, which shows that net interest or interest payments on the U.S. debt are going to double over the next 10 years. Right now, if you look at the OECD and you compare the U.S. to all of the other members of the OECD, they're actually the worst of all. That is their net interest payments to GDP levels. Believe it or not, they're actually more than double the next country, which is Greece, of all countries. So not saying a lot. Inflation is creeping back, and people see it, feel it, realize it. And here's just sort of an interesting sort of note. If you look at the monthly inflation rate in January and look how it's been climbing since October, it's been rising. If you annualize, I know this is not scientific and I'm projecting, but if you were to annualize January's 0.5%, we would actually be at 6% per year. And I think that really what's happening is consumers are actually feeling that, not believing the official numbers and feeling, these kinds of annual inflation rates. This shows us the 5-year break-even inflation expectations. We're actually back to a 2-year high at 2.65%. This is from early February. And the University of Michigan, that does a lot of research on this and does surveys, and they look at consumer inflation expectations. Consumers actually think we're facing 4.3% over the next year. So well above, in fact, almost 50% above the official sort of 3% current rates of CPI. This chart shows us $100 back in 1913 and what it would take to spend today to buy the same basket of goods. Well, you can see what happened in 1913. We know that the Fed was established, and then you start to see the rate rise considerably, 1971 or so. Does anybody know what happened in 1971? Well, gold window was closed, exactly. So look at what happened in terms of the rate of inflation from that point. And if you look at the last 5 years, which was in the earlier chart, look at what happened in inflation since then. So not only was it a lot sharper from 71 onwards, it's gotten even sharper in the last 5 years. So what cost you $100 in 1913 would cost you $500 in 1974 and $3,200 today. So it's no surprise that Costco now sells $100 to $200 million worth of gold and silver every single month. People are really starting to clue in. This, I thought, was an interesting chart. It's global reserves and how gold now exceeds the euro in global central bank reserves for the first time ever. The black arrow at the top shows how, and in fact, if you look at the two arrows, they show how that red section in the middle is getting narrower and narrower, and that's US dollars as central bank reserves. About 20 years or so ago, I think that the US dollar was about 60%. We're now right around or below 50% of reserves are in US dollars. And most of the gain, especially in the last 5 years and even in the last, say, 10 or 20 years, has actually been gold. So we've seen central banks move more and more away from fiat currencies, in fact, and more towards gold. In the last 3 years, we've actually seen them buy 1,000 tons of gold each and every year for the last 3 years, which represents almost a quarter of all the gold sold was actually physical gold was going into central bank reserves. You know, these are the kinds of things, and this is the kind of environment where you're hearing and seeing things that you would have never thought 10, 15, 20 years ago that you'd be hearing, and especially from, more mainstream and elite kind of contributors. The first quote is from Scott Bessent, who's now the U.S. Secretary of the Treasury, and he said this, I think this was the middle of last year: "We're also at a unique moment geopolitically, and I could see in the next few years that we are going to have some kind of a grand global economic reordering, something on the equivalent of a new Bretton Woods." Again, not the kind of thing you'd expect to hear from a guy who's about to become the Secretary of the U.S. Treasury. And just recently, in Fortune magazine, an article by Greg McKenna said, "Adjusting the bookkeeping on America's gold reserves could add $750 billion to the U.S. Treasury overnight." Now, he's saying this because Scott Bessent has been saying that they're going to start to look at the asset side of the U.S. balance sheet and start to monetize some of these assets. He didn't specifically refer to gold, but other than that, and probably some land and some real estate holdings, some physical things, that's one of the few ways they could start to bring more value to the U.S. balance sheet. And you have to ask yourself, why would you do that? Also, I mean, one of it could be to help generate credibility. The other could be to help perhaps back printing of more currency. So I guess we'll have to see how that plays out. An interesting point is that now we've got Trump back as president, and to look at what the implications might be for the dollar. At least we have one prior mandate from him. This was in 2016-17 for 4 years. And in the run-up to his election, the dollar rose. And then about a month or so after inauguration, we started to see the dollar index fall. And over the next year, it fell 11%. And I think we're going to see the same kind of thing happen this time. We've started to see that play out. The chart on the right shows the few months leading up to the election, and we've started to see the dollar index peak at around 110. We're at about 106, 107 right now. And if you look at how the U.S. dollar, the history of U.S. dollar cycles, how that has played out, you had a peak in 1984 or so, another one in 2001. Successively lower peaks. It looks like the most recent one, around 110, is the most recent peak. Both prior peaks bottomed around 85.90. I think that's maybe a little bit generous this time, but even if we do bottom in that level, that's still around 10 to 15% below where we are now in the U.S. dollar index. That wouldn't surprise me. We could get there potentially pretty quickly. So certainly something that is worth thinking about, and how that could be bullish for precious metals. So let's switch to silver more specifically now, and why I think it's really what I call a generational opportunity. We've got rising demand for silver. We have industrially, we've got increasing investment demand, and all of this in the face of limited supply and even a squeeze recently, which I'll get into in a moment. But really, if you add all these together, you have a very, very bullish case for a secular silver bull market. So this is silver mine supply. That's the blue part of the chart of the bars. That yellow arrow, that line, is not very steep, but that's because of the range chosen on the left. But so mine supply peaked in 2016. It's been falling since. S&P Global believes that even over the next few years, we're not going to see that recuperate at all, especially from primary silver mining. So bullish again for silver prices, given that demand is rising and supply is falling. Economics 101, we see that silver demand has taken off since 2020, and we're in deficit ever since 2021. Last year was the same. We have the Silver Institute saying that we're going to see deficits persist for several more years. They actually think we're going to reach a new a new high in silver deficits, a new record silver deficit at some point over the next 5 years. So that's something to watch once again. It's kind of like the perfect storm in many ways for the outlook for silver. Now, I was talking about a squeeze earlier in one of the previous slides, and just in the last few months, something very interesting and intriguing that's been happening is that since Trump has been talking so much about tariffs, we've seen a lot, like record amounts of metal flowing, silver and gold flowing out of London and mostly into New York, to some extent into China, to the Shanghai Futures Exchange. And in London, just in January alone, we had the largest single monthly drop. It was 70 million ounces flowed out of London. Again, most of that going to New York. And these are the lowest, this was the largest drop in the last 10 years since they started tracking these numbers in London. So as you can see, the COMEX in New York has been the beneficiary. We see that spike in the last few months. Traders and investors are trying to get ahead of the potential of tariffs on silver, for example. And if they have to deliver into their contracts, that they don't have to buy that metal at, with a 25% markup on it, potentially. So they're trying to get their hands on it right away so that they don't have that risk. And if you're a bit of a conspiracy theorist, there's some talk about how, and if you go back to that slide I had earlier about a global economic reorganization, some are thinking that the idea is to actually try to get the metal back into the U.S. before some kind of a financial reset. I don't know. I guess anything's within the realm of possibility these days, the way things are going, but that's something to consider, I guess, as well. This is an interesting chart that's put out by Incrementum. They do some fantastic research, and so that gold-colored line is actually what they call the world silver price. They take silver priced in a bunch of currencies around the world, and they compare it to the US dollar silver price, which is the dark blue line at the bottom. And so what's interesting here is that you see that for about 5 years, from 2015 to about 2020, there was a gap, which is fine. If you look, by the way, that gold line is the price that everyone else pays for silver, let's say on average globally. So that's really what they sort of see as the silver price. We see that gap, and that gap kind of maintained itself for about 5 years, and then COVID hit, and it had this global, money printing extravaganza take off. And so the gap was there, but the gap widened. As you can see, the gap is wider here than it was for those previous 5 years, and it stayed wider. And in the last few years, it's gotten even wider. So what that means is that if you imagine that you're a non-US silver investor, you're seeing the price of silver just go higher and higher and higher. So again, really quite bullish for silver. Some perspective on silver, how silver has performed in the last year. The blue line at the bottom is the S&P, which did pretty well, up 22% in 12 months. This slide was actually produced a week or two ago, so given the last few days of action, that might not be quite so accurate, but it still gives you a good perspective. S&P up 22% in the last year. Silver doubled that return with 44% return from about the end of February or so, 2024. So really pretty spectacular. Silver still represents less than 0.1% of the wealth globally. If you look at when silver spiked to $50 in 2011, it was still less than 0.07% of the wealth globally, and we're at about half that level right now. So if you imagine that, silver, if everyone still continued to own silver to the same extent as they do now, and silver were to double in price without anything else moving, it would still be at about less than 0.07% of the wealth globally. So the upside potential is really pretty tremendous when people start to get interested. This is a really interesting chart from a colleague, Jordan Royburn, who writes an excellent newsletter called The Daily Gold. And he generated this chart where he looked at how silver behaves after gold hits an all-time high and breaks out. And so all of these lines are analog. So these previous times gold did that, and these are the silver price gains in that scenario in these different prior breakouts. Now, where I have the red circle, which is hard to kind of see, it's actually the middle of the black line that starts over here, which is the current bull in silver, which started about a year ago. And so to just get some perspective, if you took the average, which is this dotted line, silver would have to basically double to do what it did on average the other 3 or 4 times, which is pretty spectacular. And if silver's at, say, $30 today, it would have to reach about $60. And I'm not saying it's going to do that, and that would be within the next sort of 12 to 18 months. It's possible. I'm not saying it's going to go there, but if you know, we've got these analogs for how it's behaved in the past. And so, again, anything can happen. Again, just, you know, supports the bullish case for the metal. Now, how silver has behaved in the last sort of 8 weeks, maybe 10 weeks or so, very, very bullish, very indicative of some strength. It did something it has not done since the late 70s, 1980. It's only the second time ever silver has done this. It has closed 8 weeks consecutively higher. And I was hoping it was going to beat that record. It didn't. It was down last week on the 21st of February. But nonetheless, very exceptional for it to behave like this. Again, doing something it's only done once before. And when it did that, you know, that was a mania phase. We're certainly nowhere near some kind of a mania phase in silver, and yet we're showing this kind of very, very bullish behavior. Levels to look at in silver for a breakout. If you look at certainly long term, I think 35 to 37 is very much a key area. We've seen, you know, it's kind of like a staircase. You see the price kind of consolidate, move sideways, and then you get this rally. It moves up. It kind of moves back and forth and stays in a new range. But that new higher level tends to become the new step and a new floor and support for it to eventually work its way to a new higher level. I certainly see 35 to 37 as that new range. And then ideally, ultimately, of course, we've seen silver test $50 twice in history. I think, you know, it's very interesting to watch because technicians are calling this one of perhaps 2 of the biggest technical breakouts in at least modern history. To have such a long period where the price obviously has backed off and moved sideways, eventually tests, and then eventually test again, has almost not happened in any other asset before. So what it speaks to is the potential on the upside once it finally breaks through those levels. To give you some idea of inflation-adjusted prices for silver, if we were to go back to where silver was in 2011, silver would have to go from its current price of around $30 to about $65, and this is official inflation-adjusted prices. To go back to its 1980 level, it would have to reach about $145 today. And again, this just speaks to the potential upside in silver. This is gold miners, to be specific, but it gives you, I think, some idea of what's going on in the silver mining space to some extent as well. We've just reached the highest level in 13 years for cash flow per share for gold miners. They're just cash producing machines right now. And the reason that we're still below those 2011 levels is because there's been so much share issuance by the gold miners, and that has sort of capped right now these cash flows. But if you were to look at gold miners as a sub-index, for example, of the S&P, it's by far the most profitable sector, would be the most profitable sector of the entire index. So gold miners are certainly a place to be right now. I'm going to speed things up. Just to kind of summarize, the potential in the juniors is really pretty spectacular. We have an analog. This is the silver junior ETF relative to the silver price. In 2016, we saw it absolutely explode higher. The silver price was up 48% within about 6 months at the beginning of that year. the silver juniors were up 240%. So they were up 5 times what the price of silver was. If we saw, looks like we have potentially a double bottom right here now. If we saw something like that happen again, silver would go from where it was in January, about $29 to about $42 by August, and the silver junior ETF would be basically 2.5 times what it was, from $10.50 to over $25. Just to kind of sum up, I write a silver-focused investment newsletter. It's the only one available that is silver only, everything from physical and mining ETFs all the way down to junior explorers. This gives you some idea of the kinds of returns we've had just in the last 12 months, in some cases as little as 2 to 2.5 months, and we've had some companies more than double in that time frame, and we've certainly taken some profits on those as well. Recently launched a free newsletter. I invite everyone to go and subscribe to that. The price is pretty good. We follow high potential silver stocks in there, and you get basically, I follow the news that these companies put out, analyze and comment on that. So you can go to thegoldadvisor.com/registration to sign up for that. Again, it's free. And you can follow me at Silver Stock Investor. I'm on X, I'm on LinkedIn. And if you want to get an idea of the overall potential in silver, my book, The Great Silver Bull, it's on Amazon. There's also a few hard copies you can buy over at registration. And that's it. Thanks very much.